We are on the monthly chart of Vedanta Limited. Now let us look at what the monthly is showing us. In the monthly, we see a clear downtrend, the break of the 50 EMA. So a good bearish bias, a weak bias from the monthly. Let us go to the weekly. In the weekly, we are again seeing a break of the 50 EMA and a good, nice downtrend has started. We can use a trend line to signify this downtrend. Yes, so this blue trend line represents the downtrend. We can see there are 1, 2 and 3 rejections, so this trend line holds good, and since this trend line is coming from the weekly chart, it is coming from the higher time frame, so it is a strong trend line. Now one more adjustment I would like to show you regarding the exponential moving average, that is the EMA. As you can see, the 50 EMA is not holding itself so important here because the rejections are below the 50 EMA. The rejections are not touching the 50 EMA. You can see here all these rejections, all these. So what we can do is we can add yet another EMA. Let us do it. We press the slash key and then type EMA. So now we have this another EMA. We will double click on the EMA and we will try out let's say 40 EMA. Is it holding good? No. Let us reduce it. Let us try 30 EMA. See, this EMA is holding itself very nicely. This 30 EMA is being respected here and again here, just like the trend line. So this EMA is good for us. Let us double click it and change the color to orange so that it's visible. So what it means is in the future we will always have a look when the price approaches or hits this EMA, this 30 EMA, because it is holding itself nicely. So we can say that the Vedanta's weekly chart is respecting the 30 EMA. So whenever the price comes back to 30 EMA or approaches 30 EMA, we will try to analyze the chart, we will pay close attention to the price action and look for any entries. So now we are waiting for the price to come up to the trend line and the 30 period EMA and see if there is any good trade opportunity. So let us fast forward the chart. So just in the next 2 weeks, we see that the price has come up to reject the trend line and the 30 EMA. Now we are also seeing a good nice candle with small body and rejecting this 30 EMA. Not quite a RC, but because of the lower wick, but it is still a good rejecting candle, average rejecting candle. Also we are seeing SCs, that is the squeezing candle formations. The bodies are getting smaller and smaller. So pretty nice price action, confirming the bearish bias from the weekly. Also let us check the Fibonacci tool. Let us see where the retracement is. Since there is a downtrend, we connect the latest high with the latest low like this. We see that the rejection is at perfect 0.618 Fibonacci level, making it a great level. Let me delete this Fibonacci tool. So the only thing of concern here is that in a downtrend we generally see lower lows, but here we are seeing higher lows. So this can signal a potential reversal of the trend. But since the overall picture is very bearish, very weak, you can see that the price has been constantly moving down in a nice pattern. So this does not affect us much. Rather, we focus our attention at this area. So once again, the monthly was bearish. From the weekly, we see that this retracement level is at perfect 0.618 level. Also we see that the trend line has been rejected. We see that the 30 period EMA is rejected and the price is in a heavy downtrend. So weak bias is also established from the weekly. Let us go to the daily and see if we see any indications of bearishness. in the daily chart we are seeing that the price is in a nice uptrend. So first let me delete this 30 period EMA or hide this because it is not relevant for the daily chart. So we just need the 50 EMA. So what we are seeing is the price has broken above the 50 EMA recently, very recently, and the price is in a nice uptrend. So let me draw a trend line. One more tip, if you are having trouble drawing trend lines, you can switch to bar chart from here. Click on bar and you can connect the lows. It will be easy for you to draw a trend line. So now the weekly is bearish, the monthly is bearish, but the daily is bullish because in the daily we are seeing a nice uptrend. So what we want is some sort of indication from the daily time frame that the price is wanting to reverse, the price is wanting to go down. And how do we get such confirmation is by the break of the trend line and the break of the 50 EMA. Both will provide us a good indication that price is wanting to go down because the higher time frames are already bearish. For those who have time during the day, during the market hours, they can also go to the 75 minutes time frame. People like so once again in the 75 minutes time frame we see that the price is in a nice uptrend. The price tried to break above the trend line here and then the price fell down, came back within the trend line, below the trend line. So this, my friends, is a very nice indication of bearishness. See, if you look at this closely, the price tried to break above the trend line, the weekly trend line. This is the weekly trend line, this blue trend line. Okay, so the price tried to break above this weekly trend line but could not sustain the breakout, and it went down immediately and fell below the trend line. So this also gives us a good bearish bias because it shows that the price is not willing to go much up. It has been rejected very nicely. The upsides are being rejected. Let us go back to the daily. Now let us fast forward the chart. We are waiting for a break of the trend line. Let us see if we get it. Here you go. So now we see that the price has broken the trend line. We'll decide to go short here at the close of this bar. When the candle closes, that is about at 3:28 PM or 3:30 PM, you can go short. Let me do this. I'll go short at the close of this candle, that is here. Where will I place my stop loss? I have two options. If you are a very conservative trader, you can place your stop loss right here at the swing high. If you are a little aggressive one, you can place your stop loss above this candle. There is this recent swing high. Let me switch to the line chart to show you. Now you can see that this is a recent swing high, this point. So at the high, above the high of this candle, we can place a stop loss, but what we will do is we will place a stop loss here to be more safe, right here above the high, and we will have a 1:1 target. Right here. Now let us see, fast forward the trade, how it plays out. The price gives a pullback, and your target is hit here. You hit your target with this candle. This is one of those beautiful trades which we cannot miss. Now if we would have placed our stop loss above the latest swing high, that is here, we were very close to being taken out. We would have ended up in loss. We just missed the stop loss by a little margin. Though we were safe, but this would have been a risky trade. If you would have placed your stop loss a little lower, then you would have been taken out for sure. As you can see, this dotted line, it means that your stop loss has been hit. But we keep it just above the high, so we would be safe here. But anyways, we decided that we keep the stop loss at the highest high, this one. Now I will show you one more important thing. Let me zoom this in. Let me delete this. Yes. Now just say that if you missed this opportunity. Now generally what happens is when the price breaks below the trend line like this, there is a high chance that it will make a pullback, a retracement before going even further. So in this case we see that it had made a nice retracement here. Once again it made a good retracement here and then decided to fall down. So how we can take advantage of the situation is by simple price action. What we look for is the RCs, rejecting candles. Now this candle right here, this is a beautiful candle. You can see that it is rejecting the 50 period EMA, perfect rejecting candle. So we already have our bearish bias established earlier. We are already bearish through the higher time frames like the monthly, weekly, and now we have already established the bearish bias from the daily. So now we have this rejecting candle here. It is rejecting the 50 EMA nice and tight. So we can decide to go short here at the close of this candle and stop loss above the trend line, and we get the targets easily. Let us go to the 75 minutes time frame. Now here you see that the trend had started turning to be a downtrend from the very early stages. I mean, even before the trend line was broken, the trend was already down. The price was making lower highs and lower lows. So if you are a 75 minutes time frame trader like me, we already had enough of evidences that the price was indeed going to move down. We were just waiting for a break of this trend line from the 75 minutes. Now if we are using the 75 minutes, we could have gone in early just using this simple trend line concept. So what we will do is we will go short with the break of this daily trend line. Now we can just set our stop loss above the bar, above this recent candle, or to be safe above this trend line and the highest point, recent high, and go for a quick 1:1. We can easily get our targets within just 6-7 candles. Always remember this, that the lower the time frame you work upon, the higher the noise you face. It means that in the lower time frames, when you analyze a chart and form a view, there are high chances that the price will make wild swings here and there and take out your stop loss before continuing with your analyzed view. But in the higher time frames, the price will straight away move to your direction and there will be less noise. So when you take trades from the lower time frames, do not go for big stop losses and big profit targets. Try to keep it small so that you do not get caught up by those wild swings. Now I will show you one more entry using the 75 minutes time frame. Let me delete this. Now we will already have our bearish bias established from all the time frames. We can see a nice pattern here. Let me draw this. So this forms a pattern of a kind of a rising wedge here. Now the price broke above this upper borderline but could not sustain. It fell back down with a big engulfing red candle, the covering candle. So it gives us that the price is not going to go up. This is a similar signal we noticed earlier, if you remember. Let me show you. Here the price went up but could not sustain there and fell back down, and just we were waiting for the price to break below this trend line and then go short. So similar things happened here. The price went up to try to break this trend line, this upper borderline of the pattern, could not sustain, fell back down. So now we are just looking for a break below this bottom borderline, and we got the break with this big red candle again. This is a momentum candle because this is a big candle. It gives us a boost. So let us just draw this short positioning tool. Now since this is a 75 minutes trade, we'll try to make it quick. We can keep our stop loss just here, just above the trend line, and go for 1:1, and the target is achieved easily. Now if you are an intraday player, the concepts will remain the same. The supports, resistances, trend lines, patterns, all the things will be remaining the same. Only thing will be the change in the time frame. That is, now you are trading with the 15 minutes time frame. Now we have already established our bearish bias from the higher time frames, and if you are trading from the 15 minutes time frame, for you the higher time frame is the daily chart, the 75 minutes or the 60 minutes. These are the higher time frames. So we have already established the bearishness from the higher time frames, right? Now coming to the 15 minutes chart, it is here where you get the pattern break. Let me delete this first. Yes, let me show you the 75 minutes first. Now this was our first trade, right? Now this was our second trade here. Now if you are a 15 minutes player, if you are an intraday player, what you will do is, let me come here. Now suppose you are here. Now we already have our bearish bias established from the daily chart, right? Now we just want a confirmation from the 75 minutes and the 15 minutes that the trend is indeed bearish, the price is going to go down. So we will look for some kind of confirmations. Now we have this rising wedge pattern, we have this fake breakout, the price tried to move up and came down. This all gives us a bearish bias, and now the price is coming with a heavy force downwards. Now we are looking for a break of this pattern. Now we will go to the 15 minutes. Again, here also we are looking for the break of this 75 minutes pattern. We will play this. Now with this candle we have a good break. We can just simply go short at the close of this candle right here. Now since this is a 15 minutes time frame, we will not have bigger stop losses. We will just keep our stop loss about this high, because this is already a big candle. So we are already playing for a 3% move in intraday. That is quite big move, and 1:1 target. And you see your target is achieved within 5 to 6 bars, that is approximately 60-70 minutes. So the concepts will be the same. You are just using the lower time frame, that is the 15 minutes time frame, to take your trade entry. The concepts remain the same even for the intraday players. The only disadvantage is the chances that you get stopped out. The chances that the price will at the end go in your direction, but before that it will take out your stop loss, because your stop loss is too narrow if you are trading the 15 minutes time frame. So in this video we covered the daily time frame, the trade made using the daily time frame, that is the positional trade. We covered a swing trade using the 75 minutes chart, and we covered an intraday trade using the 15 minutes chart. So this was quite a good example for all different types of traders. By default I am a positional trader because I don't like noise, and I have come to a conclusion after analyzing all my trades that positional gives me better accuracy, gives me better returns, and gives me a better psychological advantage. The only issue with positional trading is the overnight risk. I mean, if you place a trade today and if tomorrow something happens, then the market may open opposite to your direction, gap up or gap down, and that may end up creating huge loss for you. But anyways, I believe that sometimes if the market opens against you, then there will be some days when the markets will open in favor of you. So this will get nullified at the end. It is only what my analysis matters, nothing else. For intraday players, this overnight risk is nullified, because they can immediately place their stop losses and the targets, and they will not carry their positions overnight. So they just make trades today and exit today. So they can just at the moment of placing the trades, they are advised to place stop losses on the spot, so that they do not get caught out by big moves. That's it. Thanks for watching. Goodbye.